All right, we're live. Thanks everyone for jumping on and joining us. Pretty interesting times in markets. Really glad to have George and Dennis here to talk about what's going on. Inflation well above the Fed's 2% target. Job growth is slowing. Unemployment rising. Consumers pulling back on spending. And of course, as one would expect with all of that, Nasdaq is closed at yet another record high on Monday. And everything continues to look just fine in markets, or does it? That's why Dennis and George are here. George from Prospero.AI, Dennis Dick from the Stock Trader Network. Just to kick it off real quick, George, last time I think we talked about your crowdfunding effort. Curious about how that's gone and where you guys are at with that.
Yeah, I don't think we had launched yet. I think we talked about it coming up. But yeah, we launched. I think we're about to cross 250K and we're getting close to 200 investors, which I think is really cool. We're having,
Nice.
People really come out in force. Yeah, and we still have 51 days to go. So it's we couldn't have asked for a better start. Really grateful for everybody that's participated already.
Great. And if people are interested in checking that out, where can they find it?
They can go to, well, we're actually, sitting at the top of the Republic page. So if you actually just go to republic.com or .co, you can see it. But I can also link it right here in case anybody wants to check it out. A lot of good info. Oh, that's
awesome.
Private chat.
That's okay. Here, I can, let me take it. And so if you are interested in checking that out, you can go right here and learn more about Prospero.AI. I love what you guys are doing. Happy, again, as I mentioned before, to be an advisor and to be helping you out with it. And I think it's a really cool project. And Dennis, obviously, you've got the Stock Trader Network, your new venture. Everyone's embarking on new ventures, but not so new. So how's that going?
It's good. It's just an offshoot. Like, obviously, we did pre-market prep with Benzinga for 10 years, and we partnered with Benzinga back in November, and then we had to figure out where we wanted to go. So we started our own network, stocktradernetwork.com. We've got a good group, good community we're building there. So slow and steady building it. I feel like we're in building phase, though. We've done zero marketing so far because we're still just building content and that. And I was talking to you guys. We'll have to get you guys over there, too, because we need content, and we want you guys over there, too. I know you guys can provide some great content for us as well. So yeah, still doing the pre-market prep show regularly 8 to 9. And then we have continued content on the Stock Trader Network throughout the rest of the day. And they are actually listening to you guys right now.
All right. Well, welcome our friends from the Stock Trader Network. And we'll, happy to join you over there too. Definitely can recommend tuning in to listen to Dennis every day to find out what's going on in markets and, where things are at. And that's, again, that's what we're here to do. So thanks again for joining us, guys. So let's jump right into it.
Sure.
I wanted to kick off because obviously I'm hearing a lot from people about GameStop and GME earnings. So before we get into markets at large, GME came out with some pretty impressive earnings report, I got to say. George, what do you think? What can you summarize what they said and what you think about it?
Oh, I mean, I was actually I didn't know that it reported. I was looking. I thought I was looking. I asked Perplexity for like a pre.
Oh no,
report.
yeah.
Sorry. Yeah. I could ask again. I mean,
Ryan Cohen can sum it up for you. Actually, he only tweets like once a month, so it's always interesting when Ryan tweets. And he tweeted last night. He says, "Not bad for a piece of crap retailer." That's what Ryan Cohen, CEO of GameStop, tweets out. Always cracks me up every time he tweets something. But yeah, so that's the CEO's official summary. Not bad for a piece of crap retailer. I say the same thing. Not bad.
You know what? I've got a we have developed an Irvin chatbot, and here, let me tell you what it says. GameStop popped into focus after a Q2 double beat, with reports citing a 22% revenue jump, a swing to profitability, a balance sheet support from $528 million in Bitcoin holdings. The company announced a special dividend in the form of a warrant, which is going to be, I believe, like a $32 warrant. Shares were up 5 to 6% after hours at around $24.94. And It has continued today. It's 24.69 now. So yeah, up a little under 5%.
Yeah.
Pretty bullish reaction. It's funny with GameStop earnings, even when they can look okay, you often see a sell-off because there's a lot of hype going into them. But this time it seems like they met the hype.
Yeah, and it's been depressed here. And I follow the GameStop story closely too as well, just because I trade everything. But it basically has been kind of in a holding pattern for the last 2 months because Ryan Cohen interviewed on CNBC about 6 weeks ago, 7 weeks ago. And one comment that he said, if you're in GameStop for the quick money, you're in the wrong stock. We're in it for the long haul here. And I think that kind of got a little bit of speculation out of the name. And that's why it's really not been doing anything. But this earnings report, picking it back up. I mean, GameStop too, you got to consider how much cash. You would know, Dave, too, if you look. I think the last time I looked, it was $12 a share in cash. So like people are saying, oh, it's going to zero. Is not the case. They've raised a lot of money. There's a lot of cash here. And there's a good brand. I mean, that's the one thing to consider on GameStop too. Everybody knows this brand. So if Ryan Cohen can really turn this around, you're sitting with half of the market cap in cash and a brand that is strong. So maybe there is a turnaround story here.
I mean, it seems like it to me. And if you look at the revenue breakdown, a major chunk, I don't remember what the exact number was, but something like well over 20% of the revenue is from collectibles now. And this is like a new business line where they are, they got someone, I think from PSA is on their board now, and they've got this whole big partnership with PSA. You can get your cards graded. I mean, I'm going to divulge something. I'm really into baseball cards, and I love collecting baseball cards. I've gotten back into it after a multi-decade hiatus because my son's into it. We're having so much fun with it, and like GameStop is one of the best places to get cards, and also to get your cards graded. And now they've got
they're doing that.
Yeah, and so you can bring your cards to GameStop, get them graded. And not only that, you can buy like packs online. I don't know if this is generally available yet, but I saw people doing this. They were like testing it out. You can buy like a pack online. In the pack, it'll have like a graded card, and you can sell that card back to GameStop, as part of like this process. So like, I think that's like a nice, real like revenue generator for them that people weren't expecting. And that's been a big part of this story.
I'm in the sports cards too. I've been in hockey cards for years, and I do the PSA grading on everything. So I've got like my cards from when I was a kid. That's how I got into it, was collecting as a kid. And then as an adult, I just love hockey. I'm Canadian, right? So I love hockey. I love all the players. So I like all the vintage stuff like 50s, 60s, 70s, 80s. And I collect. I go to the shows and I do that. And, now GameStop. So I go to my local GameStop and start looking at these cards. You could do it.
Good. No, you can't. Smart. You can't in Canada, Dennis.
Come on.
Yeah, I know. Me too. I just bought a Sidney Crosby autographed card, and I want to get it authenticated. And I can't do that.
The GameStop stores aren't doing it here. We got to get Ryan on that. Come to Canada. We need the collectibles GameStop store in Canada, because collectibles is huge. It's a huge market there. Huge.
Yeah. And growing very quickly. If you look at the prices the Topps charges for boxes, crazy.
Yeah. And the grading costs too. I mean, PSA just kills it. That's got to be the best business. PSA should go public. That's got to be like the best business there. It's just a printing press. Oh, we'll touch your card and we'll take 10% of the value of it for telling you what it is. Yeah, it's awesome.
Amazing, right?
Yeah.
So what about the other big earning? I think it was a big earning story. Was Oracle, right? Dennis, have you been paying attention to Oracle today?
Yeah, for sure. I mean, obviously, I'm sure George on Oracle is going to be on this too with AI. The AI, this is just ignited. This is going to be the conversation where we're going to go into here. Oracle has ignited the AI trade here again. I don't think anybody expected this type of revenue growth. So it's funny. On the initial report, and we were trading it on Stock Trader Network, on the initial report, it was a miss and a miss. They actually traded down 17 points. But then the press release comes out and it has the guidance just kind of hidden right down at the bottom of it. And when you're digging into the guidance there, they talk about all this growth. And I'm just trying to grab it here, actually, from last night. They jump into the growth metrics, and that's where it really came from. I can't find
what an insane price movement.
And it was all this growth numbers. And they were talking about just growth in data center infrastructure. And that's one portion of their revenue right now. It's fine. I can't find the numbers here right now, so I'm just going to go from my memory. But I believe it was like their data center infrastructure numbers last quarter were $3 billion. They're projecting that out to 2030 to be $144 billion. So that one piece is projected to be basically take over Oracle and be like their driver. So it's a small piece of revenue for the company right now, only like 15 to 20% of the revenue. It's eventually going to be like the majority of the revenue is what they're projecting. And I don't think anybody was ready for that kind of growth. Market makers, obviously not, because the expected move was a hell of a lot less than this, but it's up 103 points, and it has fully ignited the AI trade and the data infrastructure trade, because you got CoreWeave flying, you have IREN, which is another name in the space, flying, and then NVIDIA, AMD, and all the AI stocks. I know, George, you follow these closely, so I'll throw it to you on this, but this AI trade just ignited.
Yeah, I mean, I think what we see in terms of how crowded these things get, it's something we talk about all the time, where it's just like, I think when, there's a positive news event, especially in AI, or, I think, crypto is another one. We do see, I think we are still seeing some short squeezes, but I think what all three of those, things kind of have in common is the retail attention, right? And like, this is the kind of move that you wouldn't expect from a company of Oracle size, right?
Yeah,
but
sure.
I'd say this is the new normal, because what you get is you get the initial move, and then you get the expectation that retail is going to follow the initial news move, and then you kind of get the momentum bots, on top of that. And I always, when we talk about these kind of things, I always kind of issue the warning, like, especially when that bot traffic gets in, they're only getting in because they know they're going to be the first ones out when it kind of crescendos. Like, that's why the bots love these trades, because they know they're just going to ride it, and then they're going to be, with their relationships and their execution, be able to get the first ones out, the moment it turns. But the momentum is very real, because, obviously then you get, I think, another wave of retail on top of the momentum bots, because all the other people that, got in it, saw it, rise, they're talking about it, it's all over social media. But I think the interesting thing we see going on here with Oracle, they're obviously a little later to the party. And I think what we're seeing is they're kind of old sales relationships that weren't early movers in AI starting to be like, we need to be in AI, right? Because Oracle was nobody's first idea of, who to go to when we're just like, oh yeah, we want to be at the bleeding edge of AI. Let's get Oracle, right? Like, I think this is probably Oracle, and they're still probably like larger sales staff than a lot of these other, cloud providers, I'd say, especially that don't focus on sales, right? I think a lot of the early movers were already on, GCP, AWS, Azure, and, that was easy. But I think, Oracle's probably the one kind of pulling people into AI that weren't there yet. And honestly, I think that's a big growth area, and that's why there's the excitement, right? Because the cloud providers don't necessarily, like the big cloud providers don't necessarily have these big sales staffs, and there are more pressure from, organizationally, for people to, get over the hump and not be like the only ones not doing AI. And I think that's where Oracle has huge potential. I'm kicking myself a little bit. There was actually a number of Prospero users that got in on the trade because it looked really good.
Nice.
In Prospero. And like, I've just been, and I'm sure we'll get to this, I've just been kind of there's been a lot of volatility in net option sentiment, especially. And that's kind of had me, hesitate a little bit, because I actually saw 2 weeks ago, I saw net option sentiment jump up. I think it was like a Thursday, jump up to like, it was in the low, like, in 0 to 10 range, which is like pretty bearish for us. And then into like the 30s to 40s on Thursday. And I jumped in a bunch of risk names, and then it went the completely opposite direction on that Friday. And that's made me a little hesitant. But yeah, I mean, it's kind of hard.
I'm looking right now at Prospero, by the way, George, and I'm impressed. The net option sentiment on Oracle, obviously it's 99 right now, but I mean, it was in the 90s, it looks like, for the whole week going into this price move. And the upside numbers were also pretty high too.
Yeah. And that's when you go, that's when you go in and you see, I mean, that is a great chart to show the value of net option sentiment, right?
For real.
Because on September 4th, it was at 37. And at open, by close, it was at 70. And then the next day at open, it was at 91 on September 5th, right? So that's about as clear as day that institutions knew this earnings was coming. Yeah, that's like, that's the kind of thing that, that happens, time and time again. And honestly, this is where, I wished I had looked at this a little closer, because that move from 37 to 91 in a day is huge. And had I known it was that move, I probably would have been more interested myself.
Yeah, so let's get a little deeper into that sort of, your source of hesitation coming in. I think in your newsletter this week, you said we've officially transitioned from a bull market to a market of uncertainty. You specifically cited the options market behavior following the Friday jobs report. So what happened? What do you think it means? And do you feel any different today, or does this like all sort of align with how you see things going right now?
No, if anything, it's a strong continuation of that, right? Because as I mentioned, a lot of the times we're looking at the combined number between SPY and QQQ on net option sentiment. Yeah, on Friday, we almost never see a same day move like this. But at open, when the market was excited, I think the combined score of those two numbers went up to like 90. And then they were down to, below 30 within the next hour when the market turned. And we just never see that much movement in both numbers in the same day, especially so quickly. So basically what we were seeing there is we were seeing the market perceive a positive move in the options market, start betting heavily for it. But there was a moment that it turned, and who knows? That could just be, the price momentum, things starting to switch, and them just like algorithms getting off the rails. Or it could be institutions. You never know if they're just basically saying, we don't know how much juice this rally has left. We're going to take our profits. It's a more conscious thing. But, what we saw on yesterday was that, they recovered a little bit on Monday in terms of QQQ, net, SPY, and option sentiment. They were back in like, I would say the 60, 70 levels combined. Then by yesterday, they closed again, near 30 combined. So we're just seeing more volatility. And then, it was basically, I think Oracle, sparked the whole market. I think CoreWeave had kind of like a positive announcement around that, saying they were going to make like venture investments. And I think that was a very, this is viewed as just like a lot more optimism that maybe the AI trade is not a bubble. Maybe it's not capped out. Whether it is, it's that's debatable. But I think, to summarize what I'm seeing, it's that both negative or perceived negative and positive events are being reacted to very strongly, because I think what we're starting to get set up on an institutional level is like a dual headline risk, where no fund wants to be the fund that said, I started shorting, this bull market at all-time highs and taking losses on that. But a fund also doesn't want to be at their next quarterly meeting. They got super bullish, and then, they have to answer questions about like, look at all these economic indicators. You really like weren't hedging better. You didn't have short positions. So I think basically we're seeing like the fear on both sides, and that is creating like a lot of, momentum trading in the options markets, and like kind of fierce, swift momentum trading as well.
Yeah, what do you think, Dennis?
I was just going to add to that. I mean, the momentum trading is very much a stock pickers market here too, because there's stocks that absolutely don't have momentum, or they get momentum to the downside. I mean, look at Synopsys today. It's down 35%, getting absolutely crushed. And it's just funny. It's like when they rally, and I've seen this, and again, I know we're going to talk ETF later on in the show, but I've been talking about ETF effects for years. I mean, it's always something that when they rally something like Oracle up 42%, they're going to sell something else off hard, because it's just balancing out of the ETFs and the ETF effects that are in there. Like today's victim, obviously, is Synopsys because it reported. But I mean, today, even looking today, you think, oh, this is a great day for the markets. Tech's really ripping. I mean, value trade is not having a good day, even with a light PPI. You've got home builders down. You've got, banks trading lower. You've got retail stocks trading down. But even within tech itself, I mean, Apple's having a terrible day. And we could probably talk about the Apple event from yesterday. Meta, Amazon, Netflix, all in the red. On a day that Oracle is up 42%. So rotation within the ETF itself, like with the Qs in itself, is driving the bus, and this stock market is basically just driven completely by ETF effects now.
All right, well let's jump ahead then. Let's talk about that. So, an interesting thing happened the other day. For the first time in the history of U.S. markets, there are more ETFs than individual equities. And now you're talking about the ETF effects that we're seeing because of this. So get into that a little bit, and what do you mean by that, and what specifically do you think traders can do to protect themselves?
I mean, you can actually do an entire. You could do, Dave, an entire trading course, like a book. You could write a book on ETF effects. There are so many different ways, and this is what we actively trade over on Stock Trader Network, are ETF effects. Simply speaking, like on a simplistic scale, you look at the Qs, and the Qs have 100 Nasdaq stocks in there. Oracle actually just went from Nasdaq to NYSE, so actually no longer a part of the Qs because it's moved over. But when you have stocks like Nvidia ripping up 4.5% today, and it's the biggest component, when you have stocks like AMD and all these AI stocks ripping higher today, that there is going to be pressure within the Qs itself on stuff that is seen as non-AI. So we can say, oh, it's natural rotation, but it's actually the effects, because if they were going to buy every tech stock higher today, the Qs would be up like 2-3%. They don't do that, though. The Qs are barely up. So when you see the Qs only up 0.3% and you've got Nvidia up 4.5%, they're selling other stuff. What are they selling? Well, they go naturally to the bigger components that are seen as non-AI plays. And that, my friend, is now Apple, which is a conversation in itself, because Apple is now, and I've been saying this for years, is a consumer staple. It is the iPhone. And it even became more of a consumer staple after the event yesterday, because they unveiled a whole lot of nothing except a lighter phone and a thinner phone. So the AI innovation is just simply, maybe it's there behind the scenes, but there's no AI product to be seen in the future. You could say, well, iPhones, we have apps, we have all that, so they're participating, but they're really not. It's a consumer staple. So, and if you look today,
although Duolingo sold off, right, when they said that the new AirPods would have a translator in them.
Qualcomm too, when they were talking about the chips conversation there. So there is obviously plays, and you got to listen to the conversation because there's stock plays to take out of those Apple calls. But I mean, when you look there today, if you bring up the consumer staples, they're down 1.33%. You can say, why are the staples so weak here today? TLT is higher. The PPI, so you'd think it's not a rates thing. The staples are higher simply because of overall ETF effects here. When you are buying up certain stocks as much as you are, it's a natural tendency, or it's a natural market maker thing to sell the stuff that isn't AI. So staples right away. There's no AI in Procter & Gamble, down 2%. There's no AI in Coke, down 0.7%. There's no AI in Costco, down 2% here today. Those are predictable moves that, like last night on the report, it's not naturally thought of everyone, oh my gosh, Oracle's going, I better sell Costco. But if you're on ETF effects, that's the trade right away. When Oracle rips up 40%, Nvidia and AMD start going, sell Costco. Why does Costco go down? It's part of the Qs. Costco is in the Qs.
Costco is in the Qs?
You want to know what's in the Qs? Because everybody thinks
I didn't even know that.
There are 25 non-tech components in the QQQ. Costco, Pepsi's in the Qs, Booking, Honeywell. You could go Comcast, Gilead, which you could argue is tech, it's biotech, but not really. It's not tech. It's not AI. Starbucks, Mondelez, Marriott, CSX, Starbucks. All part of the Qs. Those stocks, if you go to that list, are probably almost all down today together. Do they have something in common? Fundamentally, no. Do they have something in common? Yes, they are part of the ETF of the QQQ, and they're looking for stuff to sell. And if you go across the board, CSX down 1%. I haven't even looked at this, but just going right through on those stocks. Costco down 2%. PepsiCo down 0.78%. Gilead trading down 0.16%. All down. Why? Because of ETF effects. It's not like PepsiCo all of a sudden is a worse company because Oracle blew it away. But because of ETF effects, it goes
and like
down.
You're saying, the market's just like
goes.
almost, it's pretty even, a little up today. Qs are up 30 basis points. But there's so much disparity in the constituents. That's super interesting. So you're saying
the mechanics of that a little more. Actually, I'm not quite grokking it. And if I'm not, maybe there's some other people in the audience.
I was just going to ask
just the math. So it has to all add up. So when we got QQQ trading up 0.27%, and you've got NVIDIA trading up 4.5%. If we go to NVIDIA, and I can just bring up, you can go, if you want to follow along, go like etfchannel.com. Quick little spot. You can just look at what they update fairly regularly. So QQQ components, NVIDIA is 9.78%. Well, when NVIDIA say it's roughly 10% of the Qs. NVIDIA's up 4.6%. That means for the QQQ, just for NVIDIA's piece, QQQ's got to be up 0.46% today, just for NVIDIA, considering no other stocks whatsoever. Well, if the Qs are only up 0.3%, then it's not even up enough just for NVIDIA. Now think about all the other AI names like Broadcom in there and all those other AI names that would be driving it up. So it's got to balance itself out.
So
now, why does this happen?
So as market makers are getting lifted on something like Oracle and NVIDIA, they're trying to keep the rest of the constituents somewhere where their notional exposure to the Qs in general remains the same. Is that what you're saying?
Yeah, so there's a QQQ algo, and I talk about this all the time too, and it runs. And I mean, it automatically, like I'm not joking. So when you see Oracle and you see, people don't believe this, but when you see a big tech, Oracle's not a good name anymore because it's not on the Nasdaq anymore, but we're using NVIDIA as an example because NVIDIA is up because of Oracle. When you see NVIDIA ripping up 2, 3, 4%, the QQQ non-tech algo automatically starts shorting all those stocks. How do I know it's an algo? Because I have a scanner showing me the 100 stocks and it all goes at the same time. They all go off at the same millisecond. Well, that's an algo. That's not a human being going peck, 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 peck. They all go off at the same millisecond. That's the algorithmic market maker saying QQQ non-tech components need to go down to balance us out. People always talk about the rotation, but there's ETF effects that drive that rotation. And I'm just using the QQQ as one example. As you have more, you can go into the SPY, you can go into, different components. You can go, if you're talking biotechs, you can do that too. When you have one component, XLY is a great example too. When Tesla's having a great day, Amazon usually doesn't have a good day. Why is that? Well, if you go into the XLY and look and break down the hood, Amazon's 23% of the XLY and Tesla's 17%. So when Tesla's ripping higher, the easiest way for the market makers to balance it out is to short some Amazon. That's the mechanics behind it. So as more ETFs launch, the ETF effects become more pronounced. With 4,600 ETFs and 4,500 stocks, it's now all about ETF effects.
It's pretty funny because that's very different. I mean, look, my experience in ETF market making is pretty dated at this point, but
sure.
When I was in it, what we would generally see is we would see the opposite. We would see that generally speaking, the constituents would be trading in one direction. Yes. And they would be trading it at either a premium or a discount to NAV across the board. And so you're sitting there making markets, and you're either buying the ETF and selling the constituents or vice versa. And at the end of the day, you've got a very strong, directional bias on either side, and you do the creation redemption in order to, hedge everything out. And it was very rare that you would be, on one side on some constituents and on the other side on other constituents. That was very unusual.
Yeah, they used to all move together, and we used to be in that markets where, you see stocks go 90% or up. How many 90% up days do you see anymore? Where there's 90% up, 90% down. You don't see that anymore. You see this balancing act and this rotation. But it is being driven because every time a new ETF is created, and it's got NVIDIA, and let's be honest here, who's creating an ETF that's focusing on Procter & Gamble? They're not. They're not. They're going into the sexy names. They want a sexy story here. So those stocks, tend to underperform just because there's nobody jumping in and getting involved in those names. But, the underlying thing is, and one thing to consider is when you're after hours market making, it's much different than intraday market making because, and I've been a market maker and done market making at Bright Trading for a lot of years, so I understand algorithmic market making very well as well. When you're doing after hours, it's a bit of a guessing game. So when you're intraday, you can literally buy and sell everything within a few cents on the Qs. It's very simple. It's liquid. Right. You can go. It's not that same way after hours because, yeah, Microsoft is liquid, Tesla is liquid, Apple is liquid. But when you go into the other components that go way down the list, you know, and if we just go grab like QQQ just for fun, look at Ross Stores in the QQQ. There's no market. So there's no bids and no offers sometimes, like nothing. There's nothing there after hours.
Yep.
So what the algos have to do is they have to guess a little bit as to, it's not like buy all that, you can't buy everything because there's no offer. So you can't just go out and buy Ross Stores to create and redeem. And the thing is, the earnings come out after hours. So this adjustment happens during a period of illiquidity. And that's why the market makers are adjusting. So they may be shorting Oracle, you know, maybe it gets up there, or they may be shorting NVIDIA, we use as the example here. Well, the hedge against it actually isn't to go and buy, you know, Mondelez, which is in the Qs, is actually to short the Mondelez as well. So it's like, you know, it's adjusting on the fly, the ETF effect. So it changes everything just because it's not intraday. The earnings aren't coming out intraday. So that's the main reason why we see these effects pronounced. And then it just continues on into the day.
Do you think that this, yeah, it does. Do you think this proliferation of ETFs is a reflection of retail's increased presence in the markets?
Yes. I mean, and now you go in even farther and you can go into like the double long Microsoft, the double long Alibaba, the double long NVIDIA, the double short NVIDIA, you know, like, and you just go, and these are just ways to get around margin rules. Let's be honest here. You know,
I know.
It's just a way to beat the regulators. That's all these things are created for, is to get around margin rules, because why in the hell do you need a double long NVIDIA? You just did buy twice as much, but you got $5,000 in your account. Well, I can buy 5,000 worth of the double long and get a little bit more exposure that way. So all these things are created just to get around.
Or buy the double long on margin. What could go wrong?
Yeah, what could go wrong?
I mean, I will say this about them, and there's some interesting ones that I'm hearing about now that have, like, you know, 2x, but also limited like max losses embedded in them, that are basically like, you know, doing options on the back end. Like, for those that have seen me on this, you know, I think they know that I'm pretty like anti-risk for retail. But like, if that's actually going to keep people away from options, I do like it for that reason. And you can sell it after hours. Like, it's not like there's a big move and like you have to wait for the options to adjust in the next morning. Like, I will say it for that. Like, you know, people are going to take risk if they're going to take risk, right? So I do think the ETF, I do like the proliferation for that reason, even though I'd much prefer people, you know, just invest in regular NVIDIA versus 2x NVIDIA. Like, there's plenty of upside in regular NVIDIA, and also plenty of downside that you don't need to be, you know, amping up the risk. But I will say that I do think these things are a lot better. If they're going to keep people out of options trading, I like them for that reason.
That's a great point, right? Let the pros handle the options side of things, right? Because it's a tough market. It's a market of sharks, and it's a market that is much less regulated, much less surveilled than equity markets. All right, now this is super interesting. I appreciate the conversation. Now I want to get into or back to, you know, this market of uncertainty. Yet, you know, the highs are really, really high, right? The Monday, like I said, we saw Nasdaq, we saw the Qs hit its 21st record high of the year. The market continues to revolve around the Magnificent Seven. You know, George, you're seeing uncertainty, and yet seeing these stocks continue to plow through that uncertainty. You know, how are you managing that? How do you handle that when you're trying to figure out, you know, how to position yourself or what to recommend to people who are listening to you?
I mean, this is not available to everyone, but I'm just staying pretty even long short, no matter what I see on either side, because it's switching so fast. And I mean, I think for anyone that like thinks about managing risk, however you manage risk, staying pretty neutral at all times, not getting too excited or too down. I mean, I think that's the only smart way to play this. Because the reality is this could go this way for the next year or two. And we could be in this market that it's just like, you know, market makers, like we're talking about, like what happened on Friday, they don't mind getting really aggressive, playing something up, because it's easy for them to get out, especially if they're not convinced it's a longer term run. I think what happens with market makers when they get in trouble is they, you know, they're convinced the market's about to drop, or they're convinced it's about to, you know, go parabolic up. and then they get caught in the other direction. I think right now what we're seeing, it's very clear that they aren't taking strong positions, and they're staying very well hedged and very quick to move if the market goes in the other direction. So I think that's how people should think about it. Don't be afraid to have SQQQ, SCC in your portfolio, especially like you maybe not want to hold them all the time, but especially as we go into, inflation readings or jobs reports or whatever, just making sure you have some insulation on the other side. Because what I do think about, what we're seeing in terms of the extreme moves, right, is that they could catch either way. I think the institutions are very prepared if it keeps running down to like more aggressively, short, as we've seen, a few days in the last like month or two, way stronger than we've seen since April. Basically, I'd say in the last month or two, we're starting to see these bigger bear days come in. And then I think, with that, you also have to be prepared. And, one of the things I said in my letter this past Sunday that, we want to do more of, that we haven't really yet this week, actually, is play the early part of the day strongly, going up as well. And I think we're seeing that today. It's probably leaving me be like, oh, let me put on a few more, bull picks right after this, because this is what I said I would do. But I think that's the other side to it, that it's just like take your gains when you can get them. And you might look at it as like, and finance that insurance that you're going to buy, right? If you like load up on these days, take your profits, and then, going into, major economic events, maybe even thinking about using, 50% of those profits to buy insurance, whether it be SEC, SQQQ, whatever. Wow. I mean, I certainly think the Supreme Court hearing on the tariffs is going to be something that you definitely want insurance for. But yeah.
What do you think, Dennis? Do you see the same uncertainty? Do you have a similar approach in terms of staying long short, or are you approaching it differently?
Well, I mean, and again, I always wear two hats. I have a short-term trading hat where I'm an active trader in and out scalping, that market maker mentality almost, maybe a little bit longer time horizon than that. And I have my long-term investing hat. So, I mean, from a long-term investment standpoint, I just try to stay in good companies at reasonable valuations. And I'm trying to just hold. And my hardest part is my trading sometimes and impacts my long-term investment, because you get an opinion on it and then you start thinking and you're like, oh, this went too far, I'm going to sell it. And then you end up not rebuying. Oracle, a great example for me. I had Oracle in my long-term portfolio for the better part of 15 years. And it ran quickly, up, and I ended up selling it, I think a year and a half ago at like $160, because I thought, this is really overdone. And yeah, sure, it pulled back after that. But now it's, it just continued. And now it's 340. I was like, why did I ever sell that? So, you're always trying to wear two different hats. So from a long-term investing perspective, try not to worry so much about the hedging, because the market timing can be tricky in a long-term aspect. But from a trading perspective, always ready on the sell button. I mean, headlines happen, news happens. To George's point, Supreme Court comes out and says, hey, U.S. has to pay all these tariffs back. I mean, I don't even understand how they would unravel this mess. I don't even understand at all how they would unravel this mess. Yeah. So that's so the headline risk is always a geopolitical risk. China goes in and invades Taiwan. We talked about this before. The markets fall 10% overnight. I mean, that, would be just an awful thing to happen for everyone. But I mean, there's always risk. Can you get the timing right to time these risks? I mean, if you're always putting hedges on, the one issue is that's going to eat away most of your longer term performance if you're always hedging. So the timing of the hedges is always critical. I think right now we're still in this market, and Oracle's showing it, where the AI rally, George was saying, it is for real. It's not going away. And I think a lot of those stocks just have relentless buy the dip mentality on them, because everybody thinks this is going a lot higher, and they're not wrong. They haven't been wrong. It's been those stocks that continue to go up. And these value names, really, the ones with the low PEs, 11, 12, 13, continue to underperform for reasons, and AI may come in and actually change the world. And, some of these other companies may be left in the dust. So I think, I'm not overly concerned that market's got an imminent crash here, but, I am aware that valuations are stretched on a lot of names.
So, I think that's a great point, and a great discussion point, because last month we had an episode with professor of finance. He's in Switzerland. He's at a Chinese university, but Didier Sornet, fascinating guy, and sort of on the other side of Taleb. And he has this software that he uses to look for and find bubbles and take advantage of them, and he's done very well with this approach. But he made a really key point, and I'm curious to hear what you think, because it was maybe obvious, but I hadn't really thought about it too much. But he said, even when there's a bubble, and even when that bubble pops, which I think almost everyone, well, I'm not, let's say a lot of people, me included, thinks that this is a serious AI bubble that we're in, and that these valuations are way overstretched, and it has all of the classical hallmarks of a bubble. But his point was, because of central bank intervention, bubble bursts now only drop 20%. He's like, when was the last time you saw anything drop more than 20%, right? And so if that's the case, and I'm coming from a world of the dot-com bubble and the real estate crash where, the stocks drop 60% or more, and you have that in the back of your mind. But if your risk to the downside is capped at 20% because of the central bank, does that change how you approach this? And does it leave you sort of less concerned in terms of the risk reward calculation?
I mean,
I was actually going to say that I hate the game theory on value, and have for a little bit, right? Because if you look at value, and just some fuzzy numbers here, right? I think a lot of tech, you could be looking at let's call it a 30% gain in any couple month period, right? And on the equivalent value with that kind of move, you're maybe talking about 5 to 10%, right? And then, to your point, Dave, you could be looking at 30% down in the other direction if it goes the other direction, where the value might be 5 to 10% down. But at the same time, right, if you have any kind of trader's mentality, if you have any kind of stop losses, you could probably avoid that 30% loss while keeping that 30% gain. And value, a lot of value funds have been struggling for multiple years. So I came from value investing. I'm not going to insult the practice in general. I just think that the risk reward of it has become really out of whack and not that interesting in this market. Maybe that'll change. But yeah, that's where I've been on it for a bit.
I mean, we are in 1999 all over again to a certain extent, because Warren Buffett, you can remember I don't know if it was Barron's or who published the report, or Wall Street Journal, whatever, but is value investing officially dead? That was in the March of 2000. And we know what happened a month later. Tech bubble burst, and Warren Buffett, all of a sudden said, I win. So, value investing does seem to, work in the long run, but we have these periods where value investing, and we've been in this period for a long time here, where value investing has not worked, where the stock with the low PE continues to go lower. I like UPS, making new lows. Stocks trades with, currently has 7.8% dividend, trading, 9 or 10 times earnings. And you think, well, how can it go lower? But I'm like, when you start thinking outside the box here, though, UPS, okay, well, if you got drone delivery eventually going to come, or if you think humanoids, or if you think self-driving cars, are we going to need a big brown truck to deliver all of our packages? Probably not. So value investing does get caught up and miss, the potential. They get disrupted. Value in stocks get disrupted more often than growth stocks, because growth stocks are doing the disrupting. It's just a matter of some survive and some, go to die, like a Sears holding. Very much disrupted. Walmart disrupted that entire everything. Kmart at one time was a powerhouse. So I think, the growth versus value thing is still there. And I forget where we started with this conversation because I went on such a tangent here. But
it's a question about with AI and its valuation where it's at, you're seeing it unfold just like you're saying, Dennis. And I think there are plenty of arguments on the other side. And, we got one here that, it's not a bubble, it's innovation. And, I can see both sides of this argument. And I can agree that there's incredible innovation happening. At the same time, we're not necessarily talking about whether there's innovation or not. We're saying our valuations ahead of, is the market ahead of its skis? Do these valuations reflect any kind of reasonable revenue reality that's coming in the near future? And to me, so far we have not seen that side of it. And so, but if the downside is capped at 20% because central banks won't let markets
just go all in on AI.
Go all right. That's what I mean. Maybe it changes the way you look at things.
Yeah.
Yeah. I also think there's always in this conversation, it's important to highlight like a key difference on the revenue side, right? Like we could talk about, like if we talk about AI as a whole, and we talk about like all of the like services, chat bots, all that kind of stuff, right? Like I think it's definitely a bubble in aggregate, right? Because not all those companies are going to survive, right? There's going to be winners as that market develops, right? But I think that is very different than compute, right? Like people are going to be paying for more and more compute, whether or not like it's working. That's clear, right? And even if you're like some of these companies will die, right? You just saw what like Meta and Apple said, in front of Donald Trump in terms of their where they're going on that. And I just think like even if some of these smaller companies or mid-sized companies don't have staying power, like the big ones are going to more than make up for it in terms of how they're going to continue to grow and finance and get people on AI. And whether that's going to be a good ROI for them or not, I have no idea. But I don't think we're going to find out for that for years. And I do think they're going to keep spending on compute. So when you look at all these like, whether it's, chips or cloud or more efficient, like eco-efficient cloud, I think all of that stuff, we are looking at another, 2-3 years of extreme growth for real. I think before people might start asking questions like, are we really getting an ROI on this?
Mm-hmm. Yeah, I think that's a totally fair point. I totally agree with you. I think that again, you want to be selling pickaxes and jeans, right, and not worried about how much gold people are pulling out of the ground. Okay, so let's we got a few minutes left. Let's pivot a bit to talk economics and Fed. Right now, the CME Fed Watch says 90% chance of a 25 basis point cut in a week, but a 10% chance of a 50 basis point cut. What do you think the market is expecting right now, and how do you think the market's going to react?
It's 25. I mean, it's 100%. It's 25. If I'd be absolutely floored if it was anything except 25. We know they're cutting, and Powell is still in charge. Waller is not in charge here yet. We want Waller was public saying, "Oh, the path could be a little bit," but he's Trump's. He's a Trump guy. So Trump wants him to cut 100. If he could. Waller would be pushing on there to go 50. They're not. Powell's still in charge here. Powell's going 25. So I cannot see them doing 50. So I would say it's 25 with 3 probably cuts this year, obviously depending on where CPI comes in tomorrow.
That's a big question. So if they start cutting, is 3% the new 2% of inflation? Like, are we accepting a 3% level of inflation?
I think they said
already cutting.
They've moved it up. Which is crazy in itself. And we know 3% isn't really 3% too. We know if you calculated CPI the way it was calculated in 1985, we're really running about 10 points higher. But they don't calculate it like that because nobody wants to hear we have 10-12% inflation still. They want to hear the nice little 2-3%. But the markets trade off that number, so that's the number we'll use is the 2-3%. I mean, that's where it at. Is inflation going to be a problem in 2026 from tariffs, from an easing Fed? From probably going to be a problem coming up in 2026. But this market is YOLO. It's all about you only live once, and it's about what have you done for me right now? This market is all about short-term gratification. It isn't worrying about 2026. It's worrying about right now. So I don't think the market's at all worried about inflation right now.
Yeah, I think that's kind of the most interesting question right there. It's not like I think inflation, between tariffs and imminent rate cuts, right? It's proving a little sticky to get it below 2.7, even without any of these cuts. So I think we have to expect it higher than this in 2026. But that's not the interesting question. The interesting question is the market going to care? And I think the one data point that I think was most interesting in all of this is the way the market reacted to the rumors that Powell was going to get fired, right? And that was one of the first times in my memory that I saw a different reaction to a structural positive, right? And the structural positive was like Powell getting fired would almost assuredly lead to, steep rate cuts, which should, in theory, help the markets, right? But the market did not react positively in that day. And I mean, the only conclusion is that it did not react positively because there were concerns about the long-term impact of that. So I think that makes this the most fascinating question, right? If, Powell ultimately decides to leave because he doesn't want to, he doesn't want to deal with the pressure or whatever. I'm not sure that's going to happen. But, even as it becomes closer that we're probably going to get, lose, at least some Fed independence, right? Is that going to start concerning the market? And I think that's where this has become and will be on an ongoing basis, a very tough market to read, but maybe it's only tougher for the people that are operating in traditional thinking capacities, right? Like here, some of us we're just like, oh, I'm worried about the economics, and everybody else is just going to be like, this thing is going up, right? like
number go up. That's all. Number go up.
Yeah,
right?
I can sit here and admit that I might be doing it wrong by saying like I'm going to manage risk, right? But that's the only way I know. That's the only process I know how to live by. But I think, right, it's got like there will be a piper to pay on this, whether or not it's like we're still increasing our spending. Like eventually our credit rate is going to go down. Eventually we might be on a path to stagflation. These are mites, right? Yep. But like there will be a piper to pay at some point in the way that we're going. I think we can all agree on that. And then the only relevant question becomes, when do people start planning for that or hedging for that? Or is that just going to be the one day that the market goes down, 20% because everybody's just like, okay, this is actually here, not it's coming. I think that's by far the most interesting and complicated question we all have to look at in the markets.
I mean, I feel like here we are in September, and we've frankly been talking about this question the entire year, and it hasn't seemed to matter to the market.
No,
the market just goes up
short
to the
sighted.
right. Yeah, I mean, I'm with you, George. Like maybe we need some younger blood on this show because now I'm feeling old. But like I'm someone who does prefer the risk management approach, and maybe that has. It certainly hasn't been the right approach this year. Buffett, he's talking about, expecting something to happen and moving into cash in a dramatic.
JP Morgan,
Diamond,
yesterday, right? Warning about always warning. JP Morgan's always
warning. Right, always warning. And how wrong they've been.
They've been wrong.
Yeah.
UBS, by the way, has a 93% recession probability. And I actually wrote about this, I think it may have been last week, and that's one of the weirdest that I was just like, oh, where are people at on the macro side? And the range of recession probability was 15% to 93%, which is really just like a hop, skip, and a jump away from 0 to 100. And I think that's a reflection of where we're at, right?
So you're saying there's a chance. I mean, it's like I don't even know what to say anymore. So it just, like what you said, Dennis, it's a YOLO market, and what we've seen and what we talked about as well, like this influx of retail, all of these products for them to choose from, these complex interactions that these products are having with the underlying symbols, and this overall trend of retirement savings entering the market in this consistent manner over time and increasing. It's like, what else are you going to do with your money? You're going to put it in the market, even if even at 4 or 5% yields. You've gotten used to 10 to 15 to 20% returns, and you're like, what am I going to do with 5% over there? You're consistently putting it into the
bond
market.
Market's in its worst bear market of years. 2.5 years here now.
Yeah,
where
nobody
bond
wants
prices
them.
are down. That never happens. But yeah,
5% yields, right?
5%. When you got Nvidia going up 100% a year, or AMD or other stocks, or you get your classic little small cap stock of the day going up 2,000%, like QMMM, or AEHL was one, the other this morning. I mean, it's just this market wants immediate gratification. They want it big, and people lever up their bets now too. Like when I was in school, we were teaching diversification and risk management. I still trade that way. Like I still trade diversified up at 2-3% bets all over the place. Now I do a lot better probably if I just went all margined in on one, and get lucky and pick the right one, and boom.
That's right.
Probably.
I see people that do better than you on Wall Street Bets all the time.
They're definitely. And nobody loses money on X or Wall Street Bets ever.
Never. It's amazing.
Never.
Never. This is not financial advice, and we'll have a legal disclaimer.
I'll put your disclaimer up there. We go. That's why they throw the disclaimer.
I mean, I think the other side to it, as much as we're mocking it, and not really, but just like kind of laughing at the state of everything that we're in, which is that, like, I think that the most succinct way to put it is we've never seen more enthusiasm for the market. I've never seen more enthusiasm.
Yeah.
But there are also legitimate economic concerns, and those two things never really went together. And economic uncertainty, that might be a better way to put it than concerns. Like, I think the Supreme Court case more than anything, right, we're about to hear a case that would just be like disastrous for if the Supreme Court said no to the tariffs, right? That doesn't mean that we shouldn't have evaluations on whether these things that are happening in our government are constitutionally in the power. That's how we were built, right? So it's doing the right thing, but I can't think of a bigger event for the economy than that case, probably in my lifetime, because it touches so many parts of it all at once. But I think, to your point, Dave, it's also just if you get some inheritance today, right? I think you'd be crazy not to put it into NVIDIA or Palantir, or maybe you want to put some in real, but you could argue that real estate's in a bubble. Now I heard a crazy stat the other day that overall new constructions are going for cheaper than old construction, and it's just I've never heard anything more bubbly in my life in that market. So it's just there's a side where we can say be this is kind of crazy, laugh at it, everything there, but also it just if someone got a bunch of money paddled in their lap today, and they told me they were going to invest in put it all in bonds, versus at least a little bit in these high, maybe one of the cloud providers, anything like that, I think they were crazy.
If you're not having a taste of AI in your portfolio, you are massively underperforming. Massively.
Yep, that's right. And you might be right. We might, this could be a bubble.
Could be 1999.
Yeah, and it doesn't matter, because who knows how long it's going to continue, and who knows what the downside is, given that it's capped, and that we've seen a clear, willingness to intervene in markets consistently ever since the Great Financial. I mean, it's really starting with the Great Financial Crisis.
Yeah.
And consistently since then. So, I don't know. Fascinating times. A fascinating conversation.
Sorry, I have one more question. I know we're wrapping up, but it just made me think of this. One more question to put to the group. Do you think, based on what we just saw with Intel, if the stock market started to go down, we'd see the government buy SPY or QQQ to support the downside?
We're headed to stagflation, right? And you look at what happened in Japan, that's exactly what they were doing, right? And I would have no problem seeing the government doing something similar in the U.S., especially under this administration. But just generally, it would not surprise me in the least.
The Trump put is alive and well, and we saw that in April, and we've never really been selling off ever. They've been buying the dip ever since. We were concerned that there was no Trump put, at the beginning of April when the tariffs were coming and the market was tanking, and we went down 10% in 3 days, and we're like, holy crap, he's actually tanking the market and he doesn't care that the market's falling. And then we realized, nope, he cares. And then they talked the market up relentlessly. They put tariffs on hold. Everything changed that day. It told the whole market that the Trump put exists. And this Trump put is bigger than any put we've ever had, because the markets go down a little bit and then he talks it back up. So, you've got this full administration supporting stock prices, and it's going to be, and with interest rates going down, it's hard to bet against stocks right now.
Yeah. Great point. Again, thank you guys so much for joining us. This is a fascinating conversation. Just to pop these back up here, if you're interested in George and Prospero.AI, check out his website at Prospero.AI, but he's also crowdfunding for a great new effort. And it's really, I'm happy to support that. And then Dennis, you can find him over at the Stock Trader Network, stocktradernetwork.com. And we'll be joining him there at some point soon to continue the conversation. Until then, we've got a great program coming up Monday, actually, an unusual day and time for us, but Monday at 1 p.m. Eastern, we'll be bringing the macro folks on to talk about the Fed cut and what we think is going on with the jobs market with Claudia and Ophir. So hope everyone can join us then. Check us out on Irvin.finance, and we'll see you all soon. Thanks again for joining, and hope you found it useful.